So how do poor credit lenders determine eligibility? Something we get asked a lot. Typically, they'll look at the type of the issue you've got. So is it late payment, default, CCJ, something more severe like debt management plans, bankruptcies, IVAs? They'll want to know what the issue is. They'll also want to know when it was and how frequent those issues have been. So if you've got a load of missed payments over a course of a long time, that's more severe than if you've just had one missed. Most impactful is the date, really, how recent the issues were. Some lenders will say if you've ever had any credit issues, they're not interested. Some will track that for the 6 years it's on your credit file. Some will look to ignore anything that's outside the 2 years, some 12 months. Some will accept even issues as recently registered as yesterday. So there's a lot of different lenders out there with all different policy on it. What credit issues do lenders accept? So as I say, if you've got no credit history, a low credit score, so you might never have borrowed before, or there might be different factors on your credit report that come together to show that you've got a low score. Often that is if you've moved address a lot, or you've got no address history, you're not on the voters roll, things like that. Late payments, so your credit card you've missed. Often different lenders will have a different opinion about this. Let's say you missed a payment 5 months ago, and you make all your other subsequent payments. That's only one missed payment, but it may, if you're still behind, show as 11111 on your credit report. Whereas other lenders might say, well, you've been behind that long, and they may look at that more severely. Missed mortgage payments are more severe than just a payment on a credit card that's been missed. The lenders tend to treat that as something that is the first thing that you should be paying, and obviously if you're taking a mortgage out, they want to know that you're going to pay your mortgage back. Then default CCJs, these will be found in your credit report in different places. Your CCJ will be shown in your public record information at the bottom, which is where you'll also find your bankruptcies. Typically they're treated the same, so defaults and CCJs for most lenders will be considered as equals. Some lenders are more particular when it comes to paying off CCJs before they'll lend to you than others. IVAs, debt management schemes, repossessions, bankruptcies tend to be the most severe thing that you could have on a credit report. Then obviously there's payday loans, and it's not necessarily seen as bad credit. However, and there are some resources out there that say that actually payday loans can improve your credit score. That may be the case, but lenders look at it as a big red flag. So if you've had a payday loan, most lenders in the country won't lend to you, certainly if it's been a recently registered one. Even if you've conducted it very well and you paid it all back, that's something that's going to be an issue for them, because essentially they're reading that as it being an indicator that you're not managing your finances properly, and then what's the risk then of them lending to you and you're not paying the mortgage. So payday loans are a big no-no, really. Other things that impact eligibility besides your credit rating. So first and foremost, if you've had bad credit, that's probably where the lenders an underwriter will start. They'll look at what the issue is, when it was, as we've said, and the reasons for it. And if they're happy with that, obviously loads of other criteria comes into play. Your credit history is just one part of that. So your employment, are you employed, self-employed, what's your income, how long have you been in that role? If you're self-employed, are you sole trader, partnership, limited company? What do the books of the business look like? You're trading at loss or profit, and your drawings or dividends and salaries from those business. There are some lenders that will consider your income as being retained in the business if you own it as well. So income is a massive one. The other things that are involved, obviously looking at the property, so they will want to do an assessment on that property to check it's suitable security for you. With that in mind, they're looking for, is this sellable? So if they had to repossess a property in future, could they sell it at a decent market rate? And they tend to consider that as, is it sound structurally, is it habitable? What kind of area is it in, and the construction type of that property for the area, is that suitable and something that is a regularly traded property. The other factors as well as property come into play: your age, so how old you are, how long you're looking to borrow the mortgage for, and the affordability of that mortgage over the time. Your deposit, so they want to know deposit, where's that coming from? Is it savings that you've built over time that you can evidence? If so, that's, most lenders will, well, all lenders will accept that. Is it gifted? If so, who's gifting it? A lot of lenders will restrict your deposits to just being gifted from direct family. Others are happy with secondary, wider family, and others are actually happy with friends and family, to wider family to gift deposits. That's pretty much it.